In 2020, buying a house made you look smart.
In 2026.
It might quietly make you broke. Not because real estate is bad, but because the rules of money have changed. And most people are still playing by 2015 logic.
Today, I'll show you the math, the psychology, and the global trends.
Explain why, for many people, renting is financially smarter right now. And if you're under 40, this could save you 6 figures. We've all heard it. Rent is throwing money away. Sounds logical. But let's question it. When you rent, you pay for flexibility. When you buy, you lock capital plus take debt. Those are two completely different financial strategies. One prioritizes liquidity. The other prioritizes stability. The question is, in 2026, which one wins? Let's say home price $500,000. Down payment 20% equals $100,000. Mortgage rate 6 to 7%. That $100,000 isn't just a down payment. It's frozen capital. Now add closing costs, property tax, insurance, maintenance 1 to 2% annually, HOA in many cities. And here's what nobody calculates: opportunity cost. If that $100,000 earned 8 to 10% annually in diversified investments over 10 years, that's serious compounding. Real estate doesn't just need to grow. It needs to outperform your alternative. Most people never run that comparison. In early mortgage years, most of your payment goes to interest, not equity. You don't own your house quickly. The bank owns most of it. And if you sell in 5 years? After agent fees, taxes, and market shifts, profits shrink fast. Buying only works long term. But 2026 is not a long-term stability era. It's a transition era. AI disruption, remote work shifts, economic rebalancing. Flexibility matters more than ever. Think globally. Remote jobs, digital income, online businesses, geo arbitrage. Why anchor yourself to one high-cost city if you can? Move to lower-cost regions. Increase savings rate. Test different markets. Follow better opportunities. Renting buys you mobility. Mobility increases optionality. Optionality increases income potential. That's modern leverage. Let's talk risk. Layoffs are normal now. Industries are shifting fast. If a renter loses income, they downsize, relocate, adjust quickly. If a homeowner loses income, EMI continues, property tax continues, insurance continues. Debt reduces flexibility during uncertainty. Liquidity protects you during uncertainty. Which position feels safer in 2026? Be honest. Here's another truth. Buying often increases spending. Furniture, upgrades, renovations, decor, maintenance. Ownership psychologically pushes consumption. Renting limits lifestyle creep. That difference alone can change your savings rate dramatically. Wealth is built by margin, not by ownership status. Now let's be balanced. Buying makes sense if you plan to stay 7-10 plus years. You have stable income. You're buying below your means. You already invest consistently. You have emergency reserves. Homeownership is powerful, but only when strategic. Buying emotionally is expensive. Buying mathematically is powerful. Most people buy emotionally. In 2026, wealth is not about owning the biggest asset. It's about keeping the most control. Renting isn't weakness. Buying isn't automatic intelligence. The smartest move? Aligning your housing decision with your stage, your risk tolerance, your mobility, your income growth path. Run the numbers, not the tradition. Because the most expensive financial mistake is copying someone else's timeline.